Hello to all of you. Thank you very much for joining us today. First day back in the office this week after what has been, I think it's fair to say, an unprecedented couple of weeks for us all, following the death of our Queen. And we've been deeply saddened, as I'm sure many have, at her passing. But I have to say that the weekend I thought was uplifting and incredible. The amount of love and devotion and respect that came out for our late Queen. However, we need to deal with matters in hand, which in this case is our full year results. So our intent today is to take you through how we see the opportunity before us, how delivery of our strategy is progressing, where the numbers for the year have landed, and how we intend to accelerate our growth profile now that we've got the foundations in place. So hopefully an exciting 25 minutes or so. Ben and I'll talk for, and then we look forward to getting some questions at the end of that. I mean, as background, our financial year has been one of a huge amount of change globally, with markets reacting positively as we came out of the depths of the COVID pandemic, and then negatively as Putin invaded Ukraine, which then drove even higher an already rising inflation rate, which is now being followed by rising and quickly rising interest rates. That has created an atmosphere of uncertainty. It hasn't led to client outflows, but it is certainly slowing decision making when it comes to investment. Not that puts us in a negative frame of mind. We're still quite positive in that regard. We'll come on to that in due course. But given the turbulent market conditions and the effect of client sentiment, on the slide that you see in front of you at the moment, we're very pleased and very proud of the results that we've managed to produce over the course of that year. Record revenue, record underlying profit margin, all underpinned by positive net flows throughout the year, in every quarter, and indeed in every month of that year. Particularly impressive, I think, given the difficulties in the second half of the year economically and from a market perspective. And this very much driven by our managed portfolio service, and in particular our business-to-business investment solutions proposition, which, if you tuned in 6 months ago, you will have heard us talk about, and we will touch on again as we go through this. Since year end, we've gone live on the SS&C platform, which is a significant achievement, particularly in our industry, but a significant achievement to go live, given that it was front, middle, and back office functionality. And that's provided us with new tech, which we can improve year on year incrementally, making sure that we remain at or near the top of the industry in terms of our digitization, which is a real step forward for us and should allow us to maintain a market leading position in this regard. As a result of the continued strength of the business, I'm delighted that we were able to announce an increase to our dividend for the 17th year. So every year since we listed the business back in 2005. And clearly that shows the confidence of the board in our strength, but also in our ability to deliver on what are ambitious growth plans. Turning to the opportunity, which is on slide 6. Just wanted to spend a bit of time on this because we in the business sit here and we think, well, this is pretty obvious stuff, and this is why we're here. But that's not the case that all shareholders and prospective shareholders understand the backdrop. So just wanted to bring this out, because whilst we're ambitious for growth, that growth is only going to come if there's a real opportunity there for us as a business. And what we're trying to do here is to show first and foremost the overall opportunity for the wealth industry as a whole, and then the opportunity for discretionary fund managers as well. So when you look at the top left, this is about the growth of wealth, and you can see that over this year and the coming years, it's expected that the overall wealth of the population is going to grow considerably. And that is for a couple of very good reasons. A, people are living longer, but what's the result of that? Is that people are going to be in retirement for longer, as a rule, and that they're going to have to deal with the effects of inflation for longer, both of which mean that you're going to need a bigger pot to start with. So the general amount of wealth that an individual needs to be able to retire is increasing, and that's going to continue into the future. And then you've also got the point around who's responsible for retirement. Now, back in the day, not that long ago, people's retirement was basically provided for by the defined benefit pension scheme of their company and the state pension provided for by the state. Well, that's changing. It's changing dramatically, and you can see here in the bottom left that 10 years ago there was a quarter as many defined contribution as defined benefit. Now there's more defined contribution than defined benefit schemes. And defined contribution schemes, by their very essence, require advice. You'll also see that the number of people with no scheme at all has reduced dramatically by more than half over that time period. You also clearly need advice at the point of taking benefits, whether that is through pension freedoms and the ability to take the whole benefit, or whether you're going into drawdown, which to my mind very, very definitely, both points very, very definitely require advice. So that's very positive backdrop for financial advisors. And you can see on slide 7 that very pleasingly, you can see that more and more clients are taking advice. And from 2016 to 21, that went up by nearly 50% over that time period. Interesting that in that period, the number of advisors has barely increased. So we have an issue with demand rising strongly, but a lack of capacity for all of those clients. So our job in all of that is to make advisors' lives as easy as possible. Hence the investment that we've made with SS&C and the investment that we make with them in the conversations that we have every day. The opportunity for advice, therefore, to me, seems incontrovertible, and I would strongly argue that this also applies to the investment managers who support advisors, such as us. So if on slide 8, you can see it's clear that expectations are for outsourcing, that is outsourcing investment management to specialists such as us, is for that to increase, not insignificantly over the next couple of years. And the reasons for that outsourcing in the middle, to my mind, are clear and understandable, and I'll come back to them in a little bit, but very much aligned to client outcomes and to business success. And DFMs are clearly well used amongst smaller and medium-sized advisors, whereas multi-asset funds are well used amongst all, but particularly with large advisors. And on that particular point, I would just say the 2 acquisitions that we've made over the last couple of years of Cornelian and of Lloyds International have very much built upon the capability of multi-asset funds. And the recent price reduction that we've made to the Cornelian risk managed fund range, which Ben is going to touch on in a little bit, and the arrival of Sarah Ackland to add her expertise in distribution. Both of those things signal a step change for us in this space. From being a net detractor to flows, we now expect multi-asset funds to be a significant contributor over the coming years. The focus on building out our multi-asset fund capability will not detract from the great work that we've been undertaking on our discretionary services, and in particular on MPS, which, as you can see on slide 9, has continued to grow really quickly, 31% CAGR at an industry level. If we could just flip one side, that would be great. We're targeting this market with 3 different offerings. So our business-to-business investment solutions offering, our platform offering, and then an offering in our own custody as well. What that does is it enables financial advisors to select a solution which is going to work for their business and indeed for the advice that they're providing to their clients. It is interesting that more and more advisors want to use one DFM, which very much plays to our investment solutions offering, where we're building propositions with advisors for their clients. It's also interesting that BPS, so bespoke on the far left there, is still growing despite the market shift towards MPS and multi-asset funds as a default solution. Lastly, on the next slide, thank you, on this opportunity, this is a fast consolidating industry, and it's very much our intent to grow market share, both inorganically as well as organically. And you can see on this slide, there's plenty to go for in terms of market share, plenty to go for in terms of the fragmented nature of the industry, but plenty to go for in terms of MPS funds and private clients in particular. So just to summarise this whole opportunity piece for you, firstly, overall wealth is increasing because, in my view, it has to. Secondly, the demand for advice is increasing due to the devolving of responsibility to the individual and the choice available to them. Thirdly, outsourcing by advisors continues apace so they can reduce the risk in their business, focus on their clients and on financial planning, and offer high quality outcomes. And fourthly, the opportunity exists to build market share through the acquisition of quality assets. So that's what I wanted to put in front of you in terms of the opportunity. And those are the opportunities that have allowed us to present the really strong results we've got here today. With which I'm going to pass on to Ben to go through the progress we've made on delivering strategy and our results in numbers.
Thank you, Andrew. Good afternoon, everyone. So I'm going to go through two sections today, update on our strategy delivery over the last year, and also briefly cover the numbers for FY22. So turning to page 13, my first slide, some of you will recall a version of this slide from last year. It really sets out our strategy and how we're going to create value on one page. And I think it's worth revisiting because it shows that we have a very clear mission and purpose, and that our vision is to be the leading investment manager for intermediaries. And against that, FY22, which I'll take you through shortly, was a very strong year of delivery. I think it's also worth stressing how ambitious we are and that we want to shape and lead the industry and not be led. And Andrew will come back towards the end to talk you through the real scope and scale of our ambition. As we've just been through, the opportunities in this market are huge, and we really feel that we are in the right place to maximise those. And we're very clear about how we're going to create value: market-leading organic growth, service and operational excellence, and high-quality agile M&A. Also, I think it's also worth just reminding everyone that we put a lot of store in maintaining our credibility and track record as a management team, and we believe we do this most effectively by doing what we say we're going to do. So I'm just going to talk you through a couple of examples. So turning to slide 14, we've made huge strides on net flows over the last couple of years. And as you can see, we've made great progress on both gross inflows and gross outflows. And in the second half of last year, our net inflows were 5.3%, which when you look at us against competitors, pretty much puts us towards the top of the pack. If I turn to slide 15, and talking about where this growth is coming from, I think this is an excellent example of why we are confident about getting market-leading levels of organic flows going forward. MPS is the fastest growing part of the market, and we've been very successful in capturing that growth, and we've won share over the last year in a highly competitive space. And this is a result of two things. Firstly, we've enhanced our regular platform MPS offering, strengthening distribution, investing in the team, and we're now on over 20 platforms. And this is working. We had 98 new IFA supporters in the year. Secondly, as Andrew mentioned earlier, Macdonald Investment Solutions has gone from strength to strength, and we have doubled FUM in the year. Increasingly, IFAs just want to work with one MPS DFM, and over the year, we became first choice for 9 new supporters. I think that's a huge stat. And they ranged in size from 20 to 30 million up to close to 200 million in terms of assets that they brought in within the year. And really importantly, the key to our success is culture, something which we think which luckily is very difficult for people to emulate. IFAs see us as the right long-term partner for their business. They see us having the right culture based on doing the right thing and making the right judgment calls. And when we combine the strength of our culture with the strength of our proposition, it puts us in a really good place when they're making such an important decision as partnering with one DFO. Again, slide 16, another example of why we should be confident about our flows in the medium term. Here, this is an example of where we're using the strength of our margin, 28%, to reinvest back into the proposition. As Andrew set out earlier, the multi-asset fund space is highly attractive, our market share is low, and we should play a bigger role. Therefore, we've reduced the price of our multi-asset funds from 75 basis points to under 50 basis points, which is going to cost us a couple of £1 million in the short term, but we should break even in about 18 months or so. So all the rest is an upside. But as you can see from the chart on the right-hand side, it really will be a net contributor to our net flows over the medium term. Only businesses with strong margins can take bold decisions like this. Turning to our next value driver of service and operational excellence, we're incredibly proud of our achievements in going live with our new system this year. And as you can see from the chart on the right, the SS&C platform is a significant chunk now of our architecture and has made a huge difference to the quality of the client and advisor experience going forward. The benefits of this change are many, from enhanced client and advisor service levels to improved efficiency and operational gearing. And this new platform is key to us maximising value creation from both our organic and inorganic ambitions. It's worth reminding everyone again that this partnership is built around a tier basis point contract lasting for the next 9 years or so, which is incredibly helpful in these inflationary times. And the marginal cost of us adding assets onto this platform are de minimis. So from both an organic and inorganic growth opportunity, this is a game changer for the group. Turning to our final value driver on M&A, the key point here is that we have all the capabilities in place to do M&A and do it really well. We have a strong network in place across the industry. We are well connected. We know what's going on. And when deals come along, we can move at pace. Once acquisitions are over the line, we have a strong internal integration capability, and we have tested these capabilities over the last 2 years with excellent results on both Cornelian and Lloyds. We now have another acquisition close to completion with the acquisition of Integrity Wealth Solutions, and this is expected to complete sometime in October. This transaction will provide insight into the IFA market and provide scale and capability to existing advice operations. These capabilities and our recent acquisition track record, combined with the SS&C go live and our ambitions, mean that we are very well placed to create further significant value through an M&A. So turning to the results themselves, overall, we are very pleased with the financial delivery in the year, with all our metrics, key metrics, moving in the right direction. Total revenue was up by 3.4%. Underlying profit was up by 12.7%. The margin was up to 28.2%. Underlying diluted EPS was up 12%. And we are very pleased to announce a final dividend of 45p, taking a total dividend for the year to 71p, which is also up by 12.7p. 12.7%, exactly in line with underlying earnings. And then the next slide, my final slide, just pointing out where we stand on capital, and we are in a very strong position. We're now producing meaningful amounts of surplus capital every 6 months, from which we can drive increases in the dividend and fund investment in the business, increasingly through bolt-on acquisitions. We expect the Integrity Wealth acquisition to complete shortly, and that will utilise a quarter of our current surplus capital, but we still have plenty of firepower left for further accretive deals. The dividend payout ratio was held flat in the year, but given the earnings momentum, we still increased it by 13%, as I've already mentioned. And as you can see, we do have plenty of room to move this upwards in the years ahead. So I now hand you back to Andrew.
Great, thank you, Ben. So So what we've talked about so far is the opportunity, which we think is enormous, both for the industry and for us within it. Our ability to deliver. We've stated in the past what we're aiming for, and we are delivering upon that. And we anticipate absolutely that we will continue to do so. And we've got the financial strength to really drive the business forward. What I want to talk to you about now is what does the future look like for us? And there's a couple of key points that I really want to drive out of this. Firstly, we've said in the past we want top quartile underlying profit margin. That's broadly where we are now, and that's where we expect to stay. What we haven't necessarily said has been specific around the level of net flows that we're looking to drive through the business at 8 to 10%. Maybe not in this year, but that is certainly the medium term target. And we can come back and talk about this year in Q&A around outlook, if you'd like to talk about that. But the ultimate is that what we want to become is a top 5 wealth manager in the UK and the Crown dependencies. And if we have strong underlying profit margin, which allows us to invest in the business, which allows us to drive those net flows of 8 to 10%, then that, along with a half reasonable market, will double the FUM over a 5-year period. But that alone will not get us into that top 5 acquisition. Will be critical, and I'll come back to that in a minute. But first and foremost, how are we going to actually achieve those flows of 8 to 10% and that profit margin? Well, as Ben has mentioned earlier, culture is a key focus of our business and a key differentiator. This culture is built upon our guiding principles, they being that we care, that we're connected, that we do the right thing, and that we make a difference. And you may or not measure, or you will note in due course that an annual report and accounts is entitled Making a Difference this year. These keep the business focused on the drivers that make us a firm and a group of people within that firm that clients and their advisors want to work with. And you ally that to strong long-term investment performance and being easy to use, then we believe that we have a very strong business case. We need the right set of propositions, and I'll come back to that in a moment, and the distribution capabilities to take it to market, and our decades of accumulated knowledge and experience of the advisor marketplace, as well as the constant conversations that we're having, help to ensure that we're in the right place at the right time with the right proposition. That proposition set is where our medium-term organic growth will be sourced. Specifically, the development of investment solutions as a primary delivery mechanism for our platform MPS has made great strides and built great relationships with a number of advisor firms, and the pipeline here does look strong. Building long-lasting relationships with advisors has powered our long-term success, and we're working hard to understand the requirements and to deliver for each individual company that we work with. As we've said in the multi-asset fund universe, we've got the proposition set, now we're investing in its distribution, and given the size of the prize, we're really excited to see what we can achieve here. And bespoke solutions remain at the core of the business, but they have a different role to play now than they did a decade ago, with a focus on really adding value where clients need it and are prepared to pay for it, in areas such as decumulation, where people need portfolios organised for tax, for vulnerable clients, where clients are particularly sophisticated, and indeed where clients just want to have their hand holding all the way through the process. Private clients has always been an important part of Brooks Macdonald, and Martin Lindsay and his Integrity team will add a huge amount of capability and experience to us, and we're really looking forward to their arrival in the next couple of months. So, to summarise here, we feel that we've got the right set of tools to power the organic growth. But as I said earlier, to be top 5, we're going to have to match that with our inorganic growth as well, which we see across these 3 different categories. So the investment manager world, very much a scale play, and very much adding assets to the platform that we've got, which creates incredible operational gearing for us as a business. And We talk about top quartile underlying profit margin, which we think is probably in the 25 to 30 range. We could certainly go significantly higher if we make the right investment management acquisitions. From an advisor perspective, we're not talking here about becoming a consolidator of IFAs. There's plenty of people in the marketplace wanting to do that. We're talking about IFAs who generally have worked with us for long periods of time, who we know, and there's trust on both sides. So again, it comes back to this culture point, coming to us and saying, actually, we're looking for an exit strategy for whatever reason it might be, and we'd like that to be Brooks Macdonald. So there's definite opportunities there. And then should transformational opportunities come up, we're not going to step away from them, because we do think that we're a partner of choice in this particular area. None of which, despite our increasing ambition around M&A, none of which means we're going to have a lesser quality to the criteria that we have for making any acquisition. We're not in the business of buying fixer-upper businesses. We want businesses that are going to add strategic value and financial value to us as a business. And crucially, we want businesses which are going to fit culturally to Brooks Macdonald. Because frankly, in this space, in wealth management, which is very much a people business, if you haven't got that cultural fit, this is value destruction, not value accretion. So that's absolutely key for us. If we move on to the next slide, Ben, do you want to touch on the investment case?
I'll just pull out a few key points. I think the first thing to say is that our investment case is deep and multifaceted. If I just pick out a couple of key points, the market opportunity is huge and it's growing, as Andrew set out at the beginning. Culture, we're a team that IFAs want to work with. We understand the market. They like the culture of us making a difference and doing the right thing. That is something that is going to put us in really good stead in the future, and as it does today. Our current broad investment proposition, we have all the building blocks and products we need to make the most of that huge opportunity. Our delivery capability, we're a team that gets things done. Getting the new system over the line in 18 months, slightly later than planned, but on budget, is a huge achievement. This is an area that's fraught with pitfalls, and we navigated them well and got that done. Our distribution reach is unrivaled with the IFAs. We've got a significant team which we're strengthening with the addition of people like Sarah, and we really know where to go and who to go and sell our wares to. And then finally, the leadership team itself is obviously broader than just me and Andrew, but we believe we've got all the right skills combined with the ambition and drive to make the most of the huge opportunities that we see.
Thanks, Ben. So to close, on slide 26, perfect, thank you. We are hugely proud of what we've achieved and hugely proud of our track record on delivery, which has put us into such a strong position. And we're hugely excited about what it is that we can achieve over the coming years. With which, we'll go back to Hannah.
Thank you both, and we've had some questions through. You've spoken there about acquisitions. Are you more likely prey than predator in the ongoing industry rationalisations? And are your troubles with the Irish Channel Islands acquisition resolved?
Cool. Yeah, okay, so the intent is very much to be predator. So I think it's a really good question, and it is a fragmented industry, and there's a lot of consolidation going on. We've worked really hard to put ourselves in a strong position where we can go out and be on the front foot and make the acquisitions that we want to make us great. There's always the chance that someone comes over the top and offers the board of a PLC an enormous amount of money. That's the same for any business on any quoted market, but we think we're in a very strong position to be on the front foot. And the absolute key is we want to be in control of our own destiny, and that's why we've put ourselves in this position. With regards to the Channel Islands, I'm pleased to say that after a very long period of time, we're right at the end of that process, having dealt with the clients as you would hope and expect that we would. So the international business, I think, is in a really good space across now, looking very much like our UK business across advisors and across private clients. So we've got high hopes for that business to really help to drive forward the net flows of the group now that we're past the issues of the past.
Thank you. Sticking with the theme of acquisitions, are there as many opportunities as you'd like, given the private equity interest?
That's an interesting question as well. There are lots of opportunities. We have a lot of conversations, and we have an enormous amount of stuff come across our desk. The private equity point is, a year ago, certainly it was the case that our competitors were likely to be private equity, and some of them have deep pockets and they're still around now. But the market conditions have changed a bit. Valuations have changed a bit, given what's going on in markets, but also the amount of interest. And actually, I think we're pretty pleased actually that we kept our powder dry last year, so as we can be on the front foot this year.
Thank you. And perhaps again, leading on from that, given the opportunity to build the business now with acquisitions and the platform you have in place, which gives you good operational gearing, does it allow you to bid higher than others in this competitive environment?
Yes, in essence, the new contract with S&C is highly geared. So the more FUM we put on the platform, the less we pay. Once we get to the top tier, it's a de minimis charge. So apart from underpinning the delivery of top quartile margin on our organic growth story, it will really set us apart on the inorganic side. So we should be able to take out significantly more synergies than the next firm at a lower risk, given the strength of the platform and its ability to be scaled up, and therefore we can potentially, in most cases, pay more for those assets in the first instance.
Thank you. Is there a long-term future for custody MPS, bearing in mind the growth of platform MPS in the IFA space?
Yeah, I think there is actually, and it really comes from the ability of Brooks Macdonald to provide a group of services to an advisor firm who maybe want to use one platform and they want to use one DFM, and if they use us for both, then there's clearly some advantage that we can provide in terms of pricing. So I do think that there's a future there, but right now the growth model is on platform. That's where the assets are, but it's great for us to be able to offer something a little bit different to that marketplace as well.
Okay, thank you. Is there a bias towards international growth with the appointment of Sarah Ackland, bearing in mind you already have a head of UK distribution?
No, there's a bias towards bringing the company together and making sure that we use the best ideas and the best of distribution across the group. I think it's great that she's joined us. Her expertise in the multi-asset fund arena in particular. She was multi-asset head at Lion Trust and head of multi-asset fund at Architas before that. That really will help us to spur that particular segment on. But she's also got international experience as well, and it's about bringing it all together so as we can get the best across the whole group rather than having a focus on international over the UK.
When you look at the market opportunities and specifically larger IFAs, why do so few outsource to DFMs?
Yeah, in the large IFA space, what you've seen over a period of time is a desire to retain control of the investment solution. So either they've got their own DFM permissions or they use multiple multi-asset funds to create that solution, which in essence is their investment solution. So rather than outsourcing that solution, they're insourcing that solution because they feel that they're adding more value to the business in that way. When you go down through the tiers, there's gaining one's own DFM permissions, for example, is a costly business and requires significant investment and over a long period of time, and they don't necessarily want to do that. And that you tend to find more truly independent firms in that space as well, who are very focused on financial planning and then outsourcing to the right provider for any given client, rather than keeping it all in-house. It's part of the reason why we're quite excited about multi-asset fund world. We do have multi-asset funds on some of the very big IFAs by panels, but we're still quite unknown in that space. So we're going to really raise our profile in that space with the large IFAs in that multi-asset fund arena. And then as we gain profile and build those relationships, hopeful that we can sell other core services to them over time.
Okay, thank you. Next, a couple on pricing. Can you run us through your decision to cut fees in multi-asset funds and not MPS, where there's a clearer growth opportunity?
Yeah, well, I think twofold. Firstly, we're growing very strongly in MPS, and we're winning market share. In the recent platform survey, we moved from 12th to 9th. Our total share of the market moved to close to 2%, up from 1.5%. So everything's going well in that part of the market. We believe our pricing is exactly where it needs to be. It's the strength of our distribution effort and our BMIS offering, which is really succeeding. So I think we feel well placed on MPS, therefore no change to pricing. On multi-asset funds, as Andrew set out, we see a huge opportunity there. Mainly through the larger IFAs and networks who are using multi-asset funds to deliver their investment solutions. We did a lot of research as to why we weren't being as successful as we wanted to be. And ultimately, it came down to the analogy I use is when they're screening for funds, there's lots of taps that need to be turned on for water to come out the other end. And one of the key ones on that is the total price of the funds for the OCF, and we were just a little too expensive, so we were failing at that point. Although the actual offering, people were very interested in, so we decided to reduce the price from 75 to 50 to really get into the right price point to drive flows. So as we say, some short-term impact on profitability, but we think medium-term will really be a driver of growth for the group, getting to that 8 to 10%.
I think we've largely covered the next question, but anything to add in terms of where you consider your prices now and in the future? Are they about right or below the market rate, and perhaps scope on what's next?
I think on pricing, we continually assess the market to see where we are on pricing. We haven't made any wholesale price changes other than the multi-asset fund for a couple of years now. We do offer scale discounts when IFAs are meaningful providers. But other than that, we think we're at the right pricing points across all the product range.
Is there a market opportunity in direct inheritance tax mitigation planning you could enter, given the amount now being raised from this tax?
So I think there's two sides to that. Definitely the case from a financial advisor perspective. So it's not only being a tool for financial advisors to go to market and try and gain additional clients. I think it's a real and living concern for a lot of people as they come up to and in retirement, particularly around whether they should be gifting assets away now or whether they need to gain some sort of protection as they retain control as they go through the latter years. So I think yes, it's an opportunity for financial advisors, ours and those who introduced to us, and yes, it's an opportunity for our AIM service, which has been very popular and very successful for a number of years now. I think we're up to 350 million in there. and I think we can take on a couple of 100 million more without having to really change the process within that market. So yeah, there's the opportunity for us to continue to grow that, not insignificantly.
Thank you. On BPS, ultimately, is the BPS offering too expensive in the IFA space with the considerably lower MPS and multi-asset pricing with near the same performance outcomes?
I would agree with you, yes, if what we were looking at was like for like. So if, for example, it's me in accumulation, still a few years away from retirement, why would I spend the extra money for BPS when I could use MPS or multi-asset funds? So the answer is I don't. I use the multi-asset funds as I go through accumulation. When I get to retirement, continuing to use me as the example, I will want to move to BPS at that point in time, to a bespoke service, because there's a number of pots and I'm going to want to get the best tax outcome from those pots. In addition to which, I'm going to want to go into decumulation. And for clients with 500,000 and above, we offer a very compelling decumulation solution, which really asset matches liabilities away over a period of time. So I think you're right. If it's for somebody who's just in accumulation, equally, I think once you get further on in your career and towards decumulation, I think there's a real need for it. And then you move into, yes, there's a need for it in court of protection, in my view. So in truly vulnerable clients, for people who've got these tax requirements, or are very sophisticated and want to have that ongoing conversation with an investment manager. And then there are some people who just like to have their hand held all the way through the process, and they're willing to pay for that. But you do need to have that added value to justify the extra payment.
Well, thank you to you both, and for our attendees for their questions today. There are no more. So it leaves me to say thank you to you both, and we look forward to an update in 6 months' time.
Pleasure. Thanks very much, all.
Thank you.